You don't want to miss this episode. Today we're breaking down the 8 non-negotiables to look for in an infinite banking policy. Now, quick note before we start. There's technically no such thing as an infinite banking policy. Infinite banking is a strategy, not a product. The product that makes it work is a high cash value, participating whole life insurance policy. We meet people every week who say, I think I already have one of those policies. Then we take a look and realize they don't. Wrong product, wrong setup, wrong company. So today, we'll cover exactly what to look for if you already have a policy or you're planning to start one, so you don't make those same mistakes. And remember, this is a process, not just a product. People often focus on what's the best company, what's the highest dividend, but the real key is understanding how to use it. Even the best structured policy won't help you if you don't know how to access it, borrow from it, and make it part of your long-term wealth strategy. One more warning before we jump in. Some people actually cancel perfectly good policies because no one ever explained how they work. Don't do that. Learn first, decide later. Alright, let's go through the 8 non-negotiables. Number 1. It must be a participating whole life policy. If your policy says universal life, indexed UL, or term, it's not the right product. You want guaranteed cash value, fixed premiums, and a death benefit that grows every year with dividends. That's what gives you both protection and predictable growth. Number 2, you should have cash value from day one. When you look at your policy illustration, the first year cash value should be around 60 to 90% of your deposit. If it's 0%, 20%, or 30%, it's not designed for infinite banking. That early access to capital is what lets you use your money immediately instead of waiting a decade. Number 3, by year 3 to 5, your cash value growth should at least equal your yearly deposit. You won't be ahead in year 1. That's normal. But by years 3 to 5, your policy should be growing by as much or more than what you're putting in each year. If not, the structure is likely off or underfunded. Number 4, choose a company with a proven track record. This part is critical. Work only with insurers that have been around for 100 years or more, pay dividends every single year in that history, a participating fund of at least $1 billion. That tells you they've survived recessions, inflation, and market crashes, and still paid dividends. Don't chase the highest dividend. Consistency and flexibility matter more. Number 5, know your minimum and maximum premiums. A well-structured whole life policy always has both a minimum and a maximum contribution. Most people fund near the maximum to build cash value faster, but you also want flexibility. Ask, can I drop to the minimum for a year or 2? Can I make up those missed deposits later? Can I restart contributions at the maximum without new medicals? Those answers vary by company, so make sure you know them up front. Number 6, the dividend option must be paid-up additions. When your policy earns a dividend, it should buy more insurance inside the policy, called paid-up additions. That increases both your cash value and your death benefit. If dividends are taken as cash or used to reduce premiums, your growth slows down. Paid-up additions keep your money compounding every single year. That's the real power of the strategy. Number 7, easy loan access and clear loan provisions. You should be able to borrow about 90% of your cash value quickly, without created checks or long paperwork. The loan process should take days, not weeks. You also want to confirm how third-party lending works. Later in life, especially for retirement income or corporate use, you may use your policy as collateral for a bank loan. Not every company qualifies for that. The lenders who specialize in these loans maintain approved lists, and they prefer well-structured participating whole life policies because they're stable, guaranteed, and backed by a tax-free death benefit. That gives the bank full confidence it will be repaid, either while you're alive or when the policy pays out. So make sure the insurer you choose is one those banks actually lend against. Number 8, work with a specialist firm. This last one protects you from all the mistakes we just covered. You need a team that truly understands the infinite banking process, not someone trying to learn it on the fly. They should help you design the policy, service it, and guide you on how to use it for business, investments, or retirement income. And remember, this is a decades-long strategy. So choose professionals who will still be around in 10, 20, or 30 years when you need them most. When it's time to borrow or create income, you'll want experienced people helping you do it right. At the end of the day, infinite banking isn't about chasing returns or fancy products. It's about control, having guaranteed access to your money, steady growth, and financial independence without relying on banks. So, focus on the process first, product second. Look for a properly structured, participating whole life policy with strong early cash value, flexibility, paid-up additions, and a reputable company behind it. And most importantly, work with people who live and breathe this strategy every day. Thanks for watching. If you'd like to learn how this strategy could fit your own financial plan, visit emeraldwealthservices.com to book a free consultation. We'll walk you through it step by step. And if you found this helpful, make sure to like, comment, and subscribe for more simple financial insights from Emerald Wealth Services.